Billions of dollars simply evaporated into thin air. The savings and loan crisis emerged as a monumental financial catastrophe in the United States, primarily impacting the 1980s and early 1990s, shaking public confidence to its core. This period saw about 3,200 savings and loan associations, many of which were small community banks facing unprecedented challenges. A major factor was the deregulation of the financial industry in the early 1980s, allowing these institutions to engage in much riskier investments than their traditional home mortgage lending. Suddenly, S&Ls could put money into commercial real estate, junk bonds, and speculative ventures, often with insufficient oversight. High interest rates in the late 1970s and early 1980s initially squeezed S&Ls because they were paying more on deposits than they were earning on older fixed-rate mortgages. This created a strong incentive to chase higher returns through dubious investments. Poor management, outright fraud, and a general lack of experience in these new high-risk areas led to massive losses. Hundreds upon hundreds of these once stable institutions began to fail, creating a domino effect across the nation. The cost of bailing out these insolvent thrifts was staggering initially, estimated at well over $100 billion, but eventually climbing to around $160 billion. American taxpayers bore the brunt of this financial meltdown, footing approximately $130 billion of the bill. The government established the Resolution Trust Corporation, or RTC, in 1989 to manage and dispose of the assets of failed S&Ls, a truly monumental task involving properties and investments worth hundreds of billions. This crisis eroded trust in financial institutions for a generation, proving that even pillars of local finance could crumble under pressure. It was a stark lesson in the dangers of unchecked speculation and the critical importance of robust regulation to protect savers and the overall economic stability of a nation. The impact was felt by millions of ordinary citizens who saw their local banks collapse, their dreams of home ownership shaken, and their tax dollars redirected to clean up the mess. The federal government had to step in with unprecedented measures like FIREA, the Financial Institutions Reform, Recovery and Enforcement Act, to address the systemic failures and prevent further contagion. This act significantly strengthened oversight and capital requirements. The number of S&Ls dwindled dramatically, from over 3,000 in 1980 to fewer than 1,000 in 1995, a clear sign of the sector's complete overhaul. The sheer volume of failed assets, $1.2 trillion, required an immense effort to liquidate. More than $160 billion simply vaporized. The savings and loan crisis of the 1980s and early 1990s truly shattered public confidence, ripping apart the financial fabric of countless American communities. This staggering debacle saw approximately 3,200 savings and loan associations, many once cherished local banks, facing unprecedented collapse. It all began with a dramatic shift in the early 1980s, when financial deregulation loosened the reins, allowing these institutions to gamble big. Instead of sticking to reliable home mortgage lending, the S&Ls ventured into risky commercial real estate junk bonds and highly speculative ventures, often with woefully inadequate supervision. High interest rates that plagued the late 1970s and early 1980s initially squeezed these thrifts, making them pay more on depositor funds than they were earning on their older fixed-rate mortgages. This created an overwhelming pressure to chase quick, enormous returns through increasingly dubious investments. What followed was a perfect storm of poor management, outright fraud, and a startling lack of experience in navigating these new high-stakes financial territories, leading to catastrophic losses. Hundreds upon hundreds of these once solid institutions began toppling like dominoes, creating a nationwide financial contagion. The eventual cost of rescuing these insolvent thrifts was monumental, far exceeding initial estimates. What started as projections slightly over $100 billion quickly escalated, eventually climbing to an astounding $160 billion. The American taxpayer was left holding the overwhelming majority of the bill, footing approximately $130 billion of that massive cleanup effort. To confront this monumental mess, the government established the Resolution Trust Corporation, or RTC, in 1989. Its Herculean task was to manage and systematically dispose of the staggering assets from these failed S&Ls, a truly immense undertaking involving properties and investments valued in the hundreds of billions. This period dramatically eroded the trust millions of ordinary citizens placed in financial institutions, a scar that lasted for a generation. It served as an unforgettable, painful lesson in the profound dangers of unchecked speculation and underscored the absolute critical importance of robust, sensible regulation designed to protect average savers and maintain the overall economic stability of an entire nation. The impact was deeply personal for millions of individuals who witnessed their local banks vanish, their dreams of home ownership suddenly become uncertain, and their hard-earned tax dollars diverted to rectify the unprecedented, widespread financial mess. The federal government was compelled to intervene with extraordinary measures, including FIRA, the Financial Institutions Reform, Recovery, and Enforcement Act, to address the systemic failures and stem further economic bleed. This act significantly fortified oversight and introduced much stricter capital requirements for remaining institutions. The sheer number of S&Ls plummeted dramatically from well over 3,000 in 1980 to fewer than 1,000 by 1995, a stark, undeniable indicator of the sector's complete and brutal overhaul. The astounding volume of failed assets, $1.2 trillion, required an immense, sustained effort to methodically liquidate and settle over many years. This crisis was a harsh reminder that even the most trusted pillars of local finance could buckle and crumble under sustained pressure. A colossal $1.2 trillion cleanup awaited the American people. The savings and loan crisis of the 1980s left an indelible scar, a financial wound that took years, even decades, to heal across the national landscape. It was a brutal reckoning where the bill for years of reckless financial gambles landed squarely at the doorstep of the American taxpayer. This monumental financial meltdown saw dramatic government intervention to halt the bleeding and pick up shattered pieces. The federal government was compelled to step in, creating the Resolution Trust Corporation, or RTC, in 1989, a new agency tasked with an impossible mission. Its primary job was to systematically manage, then dispose of vast assets from hundreds upon hundreds of failed S&L institutions. This involved an astonishing $1.2 trillion worth of properties and investments for liquidation over many years. This enormous figure represented countless homes, businesses, and financial instruments. It was a sustained, grueling effort involving thousands of transactions to recover lost funds. Public trust in financial institutions was deeply torn. Millions of ordinary citizens witnessed their local banks vanish. Home ownership dreams became precarious and uncertain. The hard-earned tax dollars of Americans were diverted to clean up this colossal financial mess. This breach of faith was a painful reminder that even trusted pillars of local finance could buckle and crumble under sustained pressure. To prevent future catastrophes on this scale, the government introduced new laws. The Financial Institutions Reform, Recovery, and Enforcement Act, known as FIREA, was enacted to fortify oversight and impose stricter capital requirements on remaining institutions. This was a direct response to systemic failures that allowed unchecked crisis growth. The number of savings and loan associations plummeted dramatically from 3,000 in 1980 to fewer than 1,000 by 1995. This stark contraction indicated the sector's complete and brutal overhaul. The crisis served as an unforgettable and painful lesson in the dangers of unchecked speculation and underscored the critical importance of robust regulation to protect savers and maintain economic stability. This painful experience reshaped financial oversight for decades.